Hello everyone, welcome back to Stock Market Meridian. Today is 19th August 2026 and you're watching today's post-market report. Let's begin with today's market performance. The Indian markets opened almost flat around yesterday's closing levels. However, from the opening session until around 11 am, markets witnessed sharp selling pressure. After that, the market started stabilizing and moved mostly sideways. Finally, both benchmark indices ended the session in the negative zone. Coming to the sectoral performance, today the chemicals and media sectors were among the biggest losers. On the positive side, only two major sectors managed to close in the green, IT and consumer durables. Now, looking at individual stocks, today's top gainers were HCL Tech, JSW Steel, Sun Pharma, Eternal and Wipro. And the top losers were Max Healthcare, Coal India, Power Grid, Bajaj Finance and ITC. Now let's quickly dive into today's top news and market updates. Now let's move to an important update for Indian markets. According to Bank of America Global Research, Indian equities need to deliver around 11.8% returns in dollar terms to make India attractive enough for foreign investors. Why? Because elevated US Treasury yields have significantly changed the risk-reward equation. The US 10-year Treasury yield is around 4.7%, while the standard US equity risk premium is around 5%. That puts the baseline return hurdle for US equities at approximately 9.7%. And after factoring in an expected 2% depreciation of the Indian rupee, the required return from Indian equities rises to around 11.8% in dollar terms. Meanwhile, Bank of America's year-end Nifty target remains at 26,200, representing roughly 9% upside from the 24,000 level. That means the expected return is still below the 11.8% hurdle, and this could keep FIIs cautious. Foreign investors have already sold around $28.2 billion worth of Indian equities during the first half of CY26. As a result, FII ownership of Indian equities has fallen to around 15.8%, its second lowest level since FY09. However, strong domestic flows continue to absorb this foreign selling. Domestic institutional investors are deploying more than $5 billion every month. Bank of America expects around $52 billion of fresh domestic mutual fund inflows during the second half of CY26, with approximately $33 billion expected to enter the secondary market. So, while FII selling remains a concern, strong domestic liquidity could continue to provide support to Indian markets. I already told you about the massive employee bonus announcements from Samsung and SK Hynix in today's pre-market report. Now, here's another major update from SK Hynix. South Korean memory chip giant SK Hynix has announced a massive 40 trillion won or approximately $28.6 billion share buyback and cancellation program. The company plans to buy back and cancel approximately $28.61 billion worth of treasury shares. SK Hynix says its intrinsic value, driven by its leadership in the AI memory market, strong cash flows, and long-term growth potential, is not fully reflected in its current stock price. The move comes as semiconductor stocks have pulled back from their June highs amid growing concerns about the sustainability of massive AI spending by hyperscalers. Interestingly, this announcement comes just 1 month after SK Hynix raised around $26.5 billion through a US listing. The company is also significantly increasing its shareholder return commitment. Its capital return target has been raised from within 50% to over 50% of cumulative free cash flow generated between 2025 and 2027. This will include dividends, share buybacks, and share cancellations. The company is also evaluating additional payouts, including special dividends, with further details expected alongside its Q3 earnings in late October. SK Hynix currently holds approximately 69 trillion won in net cash. This massive capital return program could also increase pressure on rivals such as Samsung to announce similar shareholder return plans. Now, let's talk about the sugar sector. Sugar stocks were in sharp focus today, despite weakness across the broader market. Stocks such as Bajaj Hindustan Sugar, Shri Renuka Sugars and Dwarikesh Sugar jumped between 5% and 10% during intraday trading. The main reason? Tightening domestic sugar inventories and rising spot prices ahead of the upcoming festival season. Lower inventory levels are supporting higher market prices and improving profit margins for sugar mills. International raw sugar futures in New York also rallied to their highest levels since May 2025. Companies including Balrampur Chini Mills have highlighted that the 2025-26 season was tighter than initially expected because of lower production, strong domestic consumption, and continued diversion of sugarcane towards ethanol production. However, there is an important policy factor to watch. The government is reportedly considering reducing or completely removing the existing 100% import duty on sugar. If implemented, this could potentially lead to India's first major overseas sugar purchase in nearly a decade. The government is also considering stricter stockholding limits for bulk traders and changes to monthly domestic sales quotas for mills. Meanwhile, sugar mills in Uttar Pradesh and Maharashtra are planning to begin crushing operations for the 2026-27 season around 10 to 15 days earlier. So, while tight supply is positive for sugar companies in the near term, any reduction in import duties could limit further upside in domestic sugar prices. Next, we have an important order win for HG Infra Engineering. The company's shares jumped more than 8% after receiving a formal letter of intent from REC Power Development and Consultancy Limited for a major power transmission project in Uttar Pradesh. The project was awarded through a tariff-based competitive bidding process. HG Infra had earlier been declared the qualified bidder for the project and will now build, own, operate and transfer the transmission assets. The project carries annual transmission charges of around 45 crore rupees. The execution period is expected to be approximately 18 months. This order further strengthens HG Infra's diversification from highways into power transmission and grid infrastructure. Next, Segal India continues to strengthen its presence in Northeast highway development. The stock rose up to 2.7%, touching an intraday high of around 317 rupees. The company received a letter of acceptance from the Ministry of Road Transport and Highways for a project worth approximately 274 crore rupees. The project was won in partnership with Rajinder Infrastructure Private Limited, with Segal India holding a 70% majority stake in the joint venture. The project involves construction of Package 2 of the Baile-Miging section of NH 913 in Arunachal Pradesh. The project has a 48-month construction period followed by a 5-year maintenance commitment after that. This order further strengthens Segal India's order pipeline across strategic highway corridors in Northeast India. And finally, we have a major manufacturing investment from Escorts Kubota. The company is developing what will become one of the Kubota Group's largest integrated manufacturing facilities in the world. The greenfield facility will be located in Sector 10 of the Yamuna Expressway Industrial Development Authority area in Gautam Buddha Nagar, Uttar Pradesh. The project is expected to involve an indicative capital investment of more than 2,000 crore rupees. The facility is strategically located near the Yamuna Expressway and the upcoming Noida International Airport at Jewar, providing strong connectivity for both domestic and international markets. In Phase 1, the facility is expected to add annual production capacity of up to 60,000 tractors and 15,000 construction equipment units. The plant will also include advanced engine production lines and a centralized spare parts warehouse. Escorts Kubota currently has annual capacity of approximately 170,000 tractors and 10,000 construction equipment units. The new facility will use the Kubota production system, automation, digital quality control, and energy-efficient utilities. The project is also aligned with Kubota Corporation's Mid-Term Business Plan 2030, with India positioned as an important engineering and global export hub. Now, an interesting update from Zomato. The company has highlighted that switching from conventional plastic packaging to eco-friendly and biodegradable alternatives could increase food delivery bills for consumers by around 10% to 30%. Currently, plastic containers and packaging account for only around 5% of the total food order value. However, alternatives such as bagasse, aluminium, paper, and earthenware are currently significantly more expensive. Zomato's Chief Sustainability Officer Anjali Ravi Kumar said these costs could gradually decline as adoption increases and manufacturing scales up. Zomato is also introducing a dedicated low plastic packaging filter on its app. Under its Plastic Free Future program, the company has already recognized more than 10,000 restaurants across 500 plus cities for adopting plastic alternatives. So the company is trying to balance sustainability with the cost impact on consumers and restaurants. So that's all for today's post-market report. If you found this analysis useful, make sure to like this video, share it with your fellow investors, and subscribe to Stock Market Meridian. I'll be back tomorrow morning with another detailed pre-market report covering global markets, important developments, commodities, and the key factors that could influence the Indian market before the opening bell. Until then, signing off. Jai Hind.